Welcome to this explainer. Today we're unpacking the thrilling, high-stakes, and honestly kind of cutthroat world of corporate mergers and acquisitions. We're talking about a landscape where multi-million or even multi-billion-dollar decisions get made, where fortunes can literally change overnight, and where massive corporate empires are either built or broken. If you've ever wondered what actually goes on behind closed doors during a massive corporate takeover, well, let's explore the data together.
Okay, let's dive into this. There's this really counterintuitive mathematical hook in the world of corporate finance, and it's the idea that 2 plus 2 can actually equal 5, right? In M&A, we call this synergy. It's basically the ultimate driving dream that if you combine two companies, the brand new entity will somehow be worth way more than the sum of its individual parts.
So here's our roadmap for today. First, we'll look at the M&A dream. Then, defending a hostile bid. After that, due diligence and valuation. Next up is financing the deal. And finally, why most takeovers fail.
All right, section 1, the M&A dream. Now, while we all probably know the textbook difference between a true merger of equals and a straight-up acquisition, in practice, almost every business combination we see out in the wild is actually a takeover. This is just where a larger company buys up a majority share of a smaller target company. They essentially become the parent company, leaving the target as a subsidiary. So why exactly do companies do this? Well, it all circles back to that 2 plus 2 equals 5 dream of synergy we mentioned, and that generally falls into 3 buckets. First, you've got revenue synergies. Think combining market share or boosting your brand power so you can bid for giant government contracts. But here's a fascinating detail from our source. Revenue synergies are actually pretty rare. Instead, companies are usually hunting for cost synergies. That means ruthless efficiency. We're talking combining warehouses or creating staff redundancies just to slash admin costs. And finally, financial synergies. This is where a massive new combined company can access cheaper finance or secure lower interest rates from banks because they're suddenly viewed as a lower credit risk.
Let's move to section 2 and see how this builds. Defending a hostile bid. Because, not all acquisitions are polite handshakes in a boardroom. There are 2 wildly different paths here. In a friendly bid, the target's board of directors actually likes the offer and recommends it to their shareholders. And since everyone's on board, they open up the books, sharing all that highly confidential internal management info so the buyer can accurately value the company. But a hostile bid? That happens when the target board flat out rejects the offer. And this is incredibly risky for the acquiring company because now they're forced to fly blind. They literally have to make an offer for the shares without seeing any crucial internal management accounting info about current financial performance.
Now, if you're on the board of a target company under attack, your absolute best defense is persuading your shareholders to reject that hostile bid. And you have a few initial maneuvers to pull this off. You have to deal honestly, of course, but you can publicly promise substantially increased future profits to prove the bidder is just lowballing you. You might also announce a massive, immediate dividend or a share buyback just to get cash directly into your shareholders' hands right now. Or if you're thinking ahead, you can preemptively change your voting structures to require a much larger majority just to approve a takeover in the first place. But what if those initial defenses just aren't cutting it? Enter the White Knight. I love this concept. If a target company is under siege by a hostile attacker, they don't have to just sit there. They can actively go out and find a friendlier savior. A White Knight is simply another company that swoops in with its own takeover bid, but at a higher price or on vastly better terms. The target basically lets themselves be acquired, but by a partner they actually want, rather than the hostile attacker.
Now, what's really interesting about this slide is this incredibly aggressive tactic called the poison pill defense. This is where a company deliberately makes itself financially toxic to a buyer. For example, the board might establish a contract saying that if the business gets sold, a massive liability instantly crystallizes, like every single director suddenly getting a 10 million rupee bonus upon sale. As you can imagine, that instantly drains value from the company the very second it's bought. But quick caveat from our source here, these types of aggressive defenses are super vulnerable and frequently open to legal challenges in a lot of jurisdictions.
Moving on to section 3, due diligence and valuation. Whenever you buy something, there's always a risk that what you get is very different from what you thought you were paying for. Our source uses this brilliant everyday analogy of buying a used car. Say buyer A is buying a car from seller B. Seller B knows the gearbox is completely shot, but buyer A has no clue. If buyer A doesn't investigate, they are absolutely going to overpay. We call this information asymmetry. And buying a corporation is exactly the same thing, just with hundreds of millions of dollars on the line. That is exactly why due diligence is utterly critical. It's the corporate equivalent of getting a mechanic to check under the hood.
So, what exactly are these corporate investigators looking for? Well, they're hunting for hidden nightmares. On the financial side, they're tearing through historical statements and heavily scrutinizing the assumptions behind any future profit projections. And on the legal side, they're digging for hidden warranties, checking asset security, or looking for tricky break clauses in supply contracts. Imagine buying a company only to realize their biggest clients have the legal right to instantly cancel their contracts just because the ownership changed? That's a total disaster scenario, and that's exactly what due diligence is meant to prevent.
Okay, so once you actually know what's inside the company, you have to value it. But remember, an acquisition actually changes the acquiring company's risk profile, so you have to match your valuation method to the new reality. For a Type I acquisition where there's zero change to financial or business risk, standard asset-based or cash flow models work just fine. But if it's a Type 2, meaning the deal alters the financial risk, say by taking on a mountain of debt to fund the purchase, you have to use an adjusted present value model. And for a Type 3, that's when you completely alter both the financial setup and the core business risk by jumping into a totally new industry. For that, you need highly complex, iterative valuation procedures.
All right, Section 4, financing the deal. So, how do we actually pay for all of this? Corporate purchases aren't always just done by writing a giant check. The purchase consideration, as it's formally called, can be structured in a few different ways. Sure, you can use existing cash or borrow money to pay cash, but you can also issue newly minted debt securities directly to the target's shareholders. Or, and this is super common, you do an all-share exchange. That's where the buying company just issues millions of brand new shares of its own stock and literally swaps them for the target company's shares. And this brilliantly illustrates the hidden danger of an all-share exchange. Let's look at a scenario where Company A buys Company B entirely with shares, but crucially, they don't achieve any synergy. The combined profits just stay flat. If you look at the bottom row, the former shareholders of the target, Company B, actually walk away with a $0.66 million gain because their earnings are now valued at the acquiring company's higher multiple. But look at the original shareholders of Company A in the top row. Their investment value dropped from $8 million down to $7.74 million. So without synergy, an all-share deal can literally destroy wealth for the acquiring company's own shareholders. It's a massive risk. But now flip it. Imagine that exact same deal, but this time that 2 + 2 = 5 synergy actually happens. Economies of scale kick in, annual earnings jump up, and when those earnings grow, the total value of the combined company skyrockets. Because of that synergy, the share price hits $9.03. Now check out the far right column. The original Company A shareholders gain over $1 million, and the former Company B shareholders gain $1.37 million. Bottom line, when synergy actually works, everybody walks away significantly wealthier. Which brings us to our final section, Section 5, Why Most Takeovers Fail. So the crucial point is, despite the millions spent on fancy advisors and endless due diligence, failure is incredibly common here. It's a pretty sobering reality. Why does it happen? Well, often the purchase price was just too high right out of the gate, which instantly kills any chance of a good return. Second, those magical cost synergies we talked about, combining warehouses and overlapping departments, they usually prove vastly more complex in reality and just never materialize. But honestly, the most fascinating part is the human element. Forcing two totally different management styles together often creates a massive clash of corporate cultures. Employees feel threatened by redundancies, and top talent, they just walk out the door, taking all their expertise with them. Plus, you can't forget that competitors aren't just sitting still. They'll aggressively adapt their own strategies to drive down market profits for everyone. Which leaves us with this final provocative thought to end our explainer today. We've seen the incredible wealth that can be generated when a deal goes right, but we've also seen just how easily that value is destroyed by overpaying, hidden legal traps, or just an inevitable clash of human cultures. So, if history and the data show us that most acquisitions actually fail to deliver on their promised value, is chasing that 2 + 2 = 5 synergy dream genuinely worth the massive risk? It's the multi-million-dollar question every CEO has to answer before they sign on the dotted line. Thanks for joining me on this deep dive, and as always, keep questioning the numbers.